Welcome back, everyone. Before we dive into part 2 of the 25 Rules of Trading Discipline by Douglas E. Zaleski, make sure you've watched part 1 first. If you haven't, the link is in the description and on the cards above. Trust me, you don't want to miss the foundational rules we covered earlier. Once you're all caught up, come back, and let's continue this journey toward mastering trading discipline. 8. You always want to be able to come back and play the next day. Never put yourself in a precarious position of losing more money than you can afford. The worst feeling in the world is wanting to trade and not being able to do so because the equity in your account is too low, and your brokerage firm will not allow you to continue unless you submit more funds. I require my students to place daily downside limits on their performance. For example, your daily loss limit can never exceed $500. Once you reach the $500 loss limit, you must turn your PC off and call it a day. You can always come back tomorrow. 9. Earn the right to trade bigger. Too many new traders think that because they have $25,000 equity in their trading account that they somehow have the right to trade 5 or 10 mini S&P contracts. This cannot be further from the truth. If you can't trade a 1 lot successfully, what makes you think that you have the right to trade a 10 lot? I demand that my students show me a trading profit over the course of 10 consecutive trading days, trading a 1 lot only, when they have achieved a profitable 10-day period. In my eyes, they have earned the right to trade a 2 lot for the next 10 trading sessions. Remember, if you are trading poorly with 2 lots, you must lower your trade size down to a 1 lot. 10. Get out of your losers. You are not a loser because you have a losing trade on. You are, however, a loser if you do not get out of the losing trade once you recognize that the trade is no good. It's amazing to me how accurate your gut is as a market indicator. If in your gut you have the idea that the trade is no good, then it's probably no good. Time to exit. Every trader has losing trades throughout the session. A typical trade day for me consists of 33% losing trades, 33% scratches, and 33% winners. I exit my losers very quickly. They don't cost me much. So, although I have either lost or scratched over 2/3 of my trades of the day, I still go home a winner. 11. The first loss is the best loss. Once you come to the realization that your trade is no good, it's best to exit immediately. It's never a loser until you get out. And not to worry, it'll come back, are often said tongue-in-cheek by traders in the pit. Once the phrase is stated, it is an affirmation that the trader realizes that the trade is no good, it is not coming back, and it is time to exit. 12. Don't hope and pray. If you do, you will lose. When I was a new and undisciplined trader, I can't tell you how many times that I prayed to the bond god. My prayers were a plea to help me out of a less than pleasant trade position. I would pray for some sort of divine intervention that never materialized. I soon realized that praying to the bond god or any other futures god was a wasted exercise. Just get out. 13. Don't worry about news. It's history. I have never understood why so many electronic traders listen to or watch CNBC, MSNBC, Bloomberg News, or FNN all day long. The talking heads on these programs know very little about market dynamics and market price action. Very few, if any, have ever even traded a 1 lot in any pit on any exchange. Yet they claim to be experts on everything. Before becoming a trading and markets expert, the guy on CNBC reporting hourly from a bond pit was a phone clerk on the trading floor. Obviously, this qualifies him to be an expert. He and others can provide no utility to you. Treat it for what it really is. Entertainment. The fact is, the reporting that you hear on the business programs is old news. The story has already been dissected and consumed by the professional market participants long before the news has been disseminated. Do not trade off of the reporting. It's too late. 14. Don't speculate. If you do, You will lose. In all the years that I have been a trader and associated with traders, I have never met a successful speculator. It is impossible to speculate and consistently print large winners. Do not be a speculator. Be a trader. Short-term scalping of the markets is the answer. The probability of a winning day or week is greatly increased if you trade short-term, small winners and even smaller losses. 15. Love to lose money. This rule is the one that I get the most questions and feedback on by traders from all over the world. Traders ask, "What do you mean, love to lose money? Are you crazy?" No, I am not crazy. What I mean is to accept the fact that you're going to have losing trades throughout the trading session. Get out of your losers quickly. Love to get out of your losers quickly. It will save you a lot of trading capital and will make you a much better trader. 16. If your trade is not going anywhere in a given time frame, it's time to exit. This rule relates to the theory of capital flow. It is trading capital that pushes a market one way or another. An oversupply or imbalance of buy orders will push the market up. An oversupply of sell orders will push the market lower. When price stagnation is present, as typically happens many times throughout the trading session, the market and its participants are telling us that, at the present time, they are happy or satisfied with the prevailing bid and offer. You don't want to be in the market at these times. The market is not going anywhere. It is a waste of time, capital, and emotional energy. It's much better to wait for the market to heat up a little and then place your trade. 17. Never take a big loss. Only a big loss can hurt you. Big losses prevent you from having a winning day. They wipe out too many small winners that you have worked so hard to achieve. Big losses also kill you from a psychological and emotional standpoint. It takes a long time to get your confidence back after taking a big loss on a trade. Big losses prevent you from having a winning day. They wipe out too many small winners that you have worked so hard to achieve. Big losses also kill you from a psychological and emotional standpoint. It takes a long time to get your confidence back after taking a big loss on a trade. 18. Make a little bit every day. Dig your ditches. Don't fill them in. When I was a young bond trader, my goal every day was to make 10 bond ties. A tie is $31.25. So if I made 10 ties on a day, I would be up $312.50. It may not sound like a lot of money to you, but it surely was to me. My mentor, David Goldberg, told me that if I could make 10 bond ties every trading day of the year, at the end of the year, I would be up $72,500 in my trading account. Not bad for a 23-year-old kid in 1982. It is amazing how quickly your trading account will build up over time just by making a little bit every day. If you are a new E-mini S&P trader, try to make just 5 or 6 points per day. If you can do that, you'll have that $72,000 at the end of the year. 19. Hit singles, not home runs. Just as I don't know of any successful speculators, I don't know of any trader who goes into a trade expecting to hit a home run and then actually having it happen. You should never approach a trade with the idea that it's going to be a huge winner. Sometimes they turn out that way, but the times that I have hit a home run on position is most definitely luck, not skill. My intent on the trade was to produce a small winner, but because I had to trade on and at the same time, as luck would have it, the Fed unexpectedly entered the market, I unwittingly had a huge winner. This probably has happened to me less than 5 times in 20 years. 20. Consistency builds confidence and control. How nice is it to be able to turn on your PC in the morning knowing that if you play by the rules, trade with discipline, and stick to your methodology, the probability of a successful day is high. I've had years where I could count on one hand the number of losing days that I had. Don't you think that this consistency allowed me to be extremely confident? I knew that I was going to make money on any given day. Why would I think otherwise? Making a little bit every day, rules number 18 and number 19, will allow you to trade throughout the trading session with confidence and control. Remember rule number 9. If you make a little bit every day, then you have earned the right to trade bigger. Thus, by following the rules of discipline, your little bit can soon turn into much more profitable days. 21. Learn to sweat out, scale out your winners. The net effect of scaling out of your winners will be an increased average win per trade while keeping your losses to your predefined risk parameters. You should never scale out of your losers. If your trade size is more than a one lot and your trade is a loser, you must exit the entire position en masse. If your trade size is more than a one lot and your trade is a winner, it is best to exit one half of your position at your first price target. If you trade with protective stop-loss orders, you should amend the order to reflect the change in trade size. Remember, you have exited one half of your position, and raise or lower the stop price, depending on whether it's a long or short position, to your original initiating trade entry price. You now are essentially playing with the house's money. You can't lose on the remaining position, and that's obviously a fantastic position in which to put yourself. Place a limit order a few ticks above or below the market. Depending on your position, sit back and relax. 22. Make the same type of trades over and over again. Be a bricklayer. A bricklayer shows up for work every day of his working life and executes with the same methodology, brick by brick by brick. The same consistency applies to traders as well. Please review rules number 6 and number 20. I have not changed my trading methodology and execution strategy in 20 years. I guess I'm the bricklayer. 23. Don't overanalyze. Don't procrastinate. Don't hesitate. If you do, you will lose. I can't tell you how many times traders have come into my office terribly depressed because they knew the market was going one way or another. However, they failed to put a position on. When I asked them why they did not put the trade on, their responses are always the same. They did not want to chase the market. They were waiting to be filled at the absolute best possible price and never got filled, or only 2 out of 3 of their market indicators were present and they were waiting for the third. The net result of all this procrastination and hesitation is the trader was correct in deducing market direction, but his profit on the trade was 0. We don't get paid in this business unless we put the trade on. Don't overanalyze the trade. Place the trade and then manage it. If you're wrong, get out. But you'll never be right unless you make the trade. 24. All traders are created equal in the eyes of the market. We all start out the day the same. We all start out at 0. Once the bell rings and trading begins, it's how we conduct ourselves from a behavioral standpoint that will dictate whether or not we will make money on the day. If you follow the 25 rules, you should do well. If you do not, you will do poorly. 25. It's the market itself that wields the ultimate scale of justice. The market moves wherever it wants to go. It does not care about you or me. It does not play favorites. It does not discriminate. It does not intentionally harm any one individual. The market is always right. You must learn to respect the market. The market will mercilessly punish you if you do not play by the rules. Learn to condition yourself to play by the 25 rules of trading discipline, and you will be rewarded. If you found this guide on the 25 rules of trading discipline by Douglas E. Zaleski helpful, don't forget to smash that like button and subscribe to the Mind TV. Your support fuels our mission to bring you more insightful and actionable content. Hit the bell icon so you never miss an update. Let's grow together. Thank you for being part of this journey.